Have you ever wondered why the market suddenly moves, sometimes within seconds after a news headline or a central bank announcement? Or maybe you saw the US dollar strengthen right after a speech by the Federal Reserve, or you saw the euro weaken right after the inflation data was released. It is not magic, it is fundamental analysis at work. So, what is fundamental analysis? Fundamental analysis is simply the study of real-world factors that move currency prices. It looks beyond charts and indicators and looks directly at the health of an economy. You can think of it like checking a person's health report before investing in them. If a country's economy is growing, then the currency tends to grow stronger as well. And on the other hand, if the economy is slowing down, then the currency tends to weaken. So in simple words, strong economy equals strong currency, and weak economy equals weak currency. So, fundamental analysis focuses on things like interest rate, inflation, employment numbers, GDP, that is the country's total economic output, political stability, and trade relationship. All these help to tell you how healthy or sick a country's economy is and can help you predict where that country's currency is going to move next. Now you should know that there are two main ways traders analyze the market: technical analysis and fundamental analysis. Technical analysis looks at charts, candles, and indicators to find entry and exit points, while fundamental analysis looks at economic reasons behind price movement. Here's a simple analogy. Imagine you are buying a car. Technical analysis is like checking the car's paint, the shape, the tires, while fundamental analysis is checking what is really under the hood, the engine, the oil, the mileage. And the thing here is that both matters. The car can look great on the outside, just like the chart can look perfect, but the engine is weak and it won't go far. This is why professionals combine both technical and fundamental analysis. You know what is happening in the country and you also read the charts. Many beginners may ignore fundamental analysis because they feel like the chart is easier to read. But the truth is, fundamentals drive price movements. Fundamentals drive the chart. Fundamental analysis is the why behind price movement. Let's say, for example, in the United States, the inflation increases. The US Federal Reserve may increase interest rates to control inflation. Higher interest rates make the US dollar more attractive to investors, and this will result to an increase in demand for the US dollar. And as the demand increases, the price follows, so the US dollar strengthens. So traders who completely ignore fundamental analysis may just see price increasing on the charts but will never understand why. While traders who pay attention to fundamentals will understand why this is happening and can even predict the price increase before it happens. Let's also see another real-world example. So imagine that the South African Reserve Bank suddenly announces a rate hike, raising interest rates by 0.5%. Here's what usually happens. Investors get excited because higher interest rates mean better returns. They start buying the South African rand. So demand for ZAR increases. And when the demand for the South African rand increases, we see USD ZAR begin to fall because ZAR is getting stronger against the US dollar. On the flip side, if the South African Reserve Bank decides to cut interest rates, investors may pull their money out looking for better returns elsewhere. Demand for ZAR falls and the currency weakens. So you can already see it. One decision from the central bank can move billions in the Forex market. That is the heart of fundamental analysis, understanding cause and effect. Now here's how all of these fit into Forex trading. Every currency pair that you trade represents two countries and two economies. When you trade Euro USD, you are not just looking at charts, you are comparing the European economy to the US economy. If the Eurozone performs better than the US, Euro USD will rise. And on the other hand, if US performs better than the Eurozone, then Euro USD will fall. It is like a tug-of-war between two economies, and the stronger economy pull the currency price to their side. You should also know that fundamental analysis works for both long-term and short-term. For short term, news releases like the NFP or CPI causes immediate volatility. This means that immediately the numbers are released to the public, you can see spikes that can last minutes or hours on the chart. Over a long term, you can see trends like economic growth, central bank policy, and inflation drive overall direction for weeks or months. Now, to properly understand fundamental analysis, you need to understand the core behind a currency's value. What makes a currency valuable? What increases the value or what decreases the value of a currency? Currencies move for the same reason price moves on the chart, and that is demand and supply. If more people want a currency, the price goes up. And if more people do not want the currency, then the price goes down. This is the simple principle that drives the Forex market, demand and supply. Unlike gold or oil, you cannot touch or see the worth of a currency. The worth of a currency is based on trust and performance. When people believe that an economy is doing well, that means the economy is growing, jobs are being created, inflation is under control. They trust that the currency will hold value. So a currency's value is determined by how strong or weak people perceive the economy backing the currency. The US dollar strengthens when investors believe the US economy is strong, and will weaken if investors believe the US economy is weak. Every price movement that you see on the chart is just traders voting their money on how much confidence they have in the economy of a country. So now that we've established that investors' trust in the country's economy determines the country's currency value, let's also see why investors may want a currency. There are 4 main reasons why investors may be drawn to a country's currency. First on our list is interest rates. Countries with higher interest rates attract investors because they offer better returns. So for example, if the Eurozone offers 8% interest rate while the US offers 4%, some investors may prefer to hold euro, at least until risk changes. Number 2 is economic growth. A growing economy means more jobs, higher spending, and strong business activity. This makes investors confident that they buy the country's currency. The next is political and financial stability. Investors hate uncertainty. So when there's political unrest, investors do not want to invest in that like economy. That's why when we see a country facing corruption, protests, weak governance, investors pull out and the currency value drops. And lastly, we have global confidence. If global investors believe a country manages debt and inflation well, they see its currency as a safe place to store money. That is why the US dollar, Japanese yen, and the Swiss franc are considered safe haven currencies. So yes, think of a currency or a country's economy as a business. So for example, if the USA Limited is growing, profits are high, the management is strong, people will invest in it, they will buy USD. And on the other hand, if UK Limited is struggling, investors pull out, they will sell the Great Britain pounds. Just like share prices, currency prices reflect confidence in the currency. Now you may have noticed that currency prices do not move alone. This is because currencies are traded in pairs. If you buy Euro USD, you are buying Euro and selling dollar. And if you sell Euro USD, you are buying dollar and selling Euro. So when the news says that the US dollar is getting stronger, it means traders across different pairs that contain the US dollar will favor the US dollar. That means they will buy the US dollar against the other currencies. So now that you understand this, let's talk about the major economic indicators that fundamental analysis show us. If you want to use fundamental analysis, you must know what the market looks at. Every week, governments and central banks release numbers, inflation, job report, trade data, and these numbers determine where the currency will move next. These are also called economic indicators. They are like a country's health report. Just like your doctor checks your temperature, your heartbeat, your sugar level to tell how healthy you are, these indicators also tell us how healthy a country's economy is. So now, let's talk about the most important indicators. First, we have interest rate. and interest rate is one of the single biggest driver of a country's currency value. Every country has a central bank, like the US Federal Reserve, the European Central Bank, the South African Reserve Bank. And their job is to keep the economy stable, and one of the ways they do this is by controlling interest rates. Here's the logic. When central banks raise interest rates, investors earn more from holding that currency. So the demand for the currency goes up and the value also increases. But when central banks cut interest rates, returns fall, investors move their money elsewhere and the currency weakens. We've done an example of how interest rates can influence a currency's value before now, so you understand it. The next indicator is inflation, and inflation shows us how fast the prices of goods and services in a country is rising. There are two main measures for inflation. First is the consumer price index, that is what consumers pay. And the second is the producer's price index, that is what producers charge. Here's why this matters. When inflation is too high, it means that the money you are holding can now buy less. And so to control this, central banks increase interest rates. So they increase interest rates to slow down inflation. On the other hand, if inflation is too low, it means that there is weak demand. And so central banks may reduce interest rates to increase consumer spending. Let's see an example to help you understand better. If the UK CPI jumps from 2% to 4%, traders might expect the Bank of England to raise interest rates. This makes the Great Britain pound stronger because investors anticipate higher returns. Now, just saying that the consumer price index jumps from 2% to 4% may not make holistic sense. So see, it's like the price of your favorite snacks jumps from £2 to £4. If that happens, you will get the nudge to watch your spending. So when this happens on a national level, so we see the price of goods, services everywhere just increasing, the central bank has to step in, and Forex traders also react immediately. Another indicator to look at is the employment data. Jobs tell you how healthy a country's economy is. When more people are working, it means that job is circulating, businesses are growing, and the economy is just doing better. So the currency also strengthens. And there are two key job indicators to look at. First, we have the non-farm payrolls, that is the NFP. NFP is the monthly US report showing how many new jobs were added, excluding farms. While unemployment rate is the percentage of people who cannot find work. So let's see an example. If the NFP report shows that the US added 300,000 new jobs in the last month, when only 180,000 new jobs were expected, that is great news for USD because strong employment means strong currency. But if 300 new jobs were expected and only 180 new jobs were added, it means that the NFP have disappointed and the dollar may drop. Jobs are like the heartbeat of an economy. If the heartbeat is strong, that means low unemployment. It means the patient, that is the economy, is healthy. Another indicator that you should pay attention to is GDP, Gross Domestic Product. GDP measures the total value of goods and services a country produces. So in other words, it is the economic size and growth rate. When GDP grows, it shows a healthy and expanding economy, and that is good for the currency. But when it shrinks, it signals trouble, and that is bad for the currency. So let's see an example. If the Eurozone GDP grows by 2.5%, compared to 1.8% expected, it boosts confidence in the euro. But if the GDP falls, the euro could weaken because investors expected slower growth. The next indicator on our list is the retail sales and consumer confidence. Retail sales shows how much people are spending in shops and online, while consumer confidence measures how optimistic people feel about their finances and the economy. Here's why this matters. Consumer spending makes a large part of most economies. When people are spending money, businesses grow, jobs are created, and the economy strengthens. But when spending drops, it is a warning sign of slower growth. The next indicator you want to look at is the trade balance. Trade balance is the difference between a country's import and export. Trade surplus, that is, export is greater than import, means that foreign buyers are purchasing your goods, and this is good for your currency. But trade deficit, meaning that imports are greater than exports, means that you are spending more abroad, and this can weaken your currency. So let's say, for example, if Japan exports more cars and electronics than it imports, it means that more people are buying the Japanese yen to be able to purchase these products, meaning that there's increase in demand for yen and the country's currency, that's yen, is going to strengthen. Another indicator to pay attention to is the Purchasing Managers Index. PMI measures how busy factories and service companies are. It is one of the earliest signs of economic direction. A PMI above 50 means the economy is expanding, but a PMI below 50 means it is slowing down. So let's say, for example, if China's manufacturing PMI jumps from 48 to 52, traders see it as recovery. The Chinese yuan may strengthen. And lastly on our list, we have housing data. Reports like building permits, new home sales, and housing starts show how active the construction sector is. A strong housing market means that people are confident enough to buy homes, usually a good sign for the economy. But if home sales drop, it may signal that consumers are struggling. So let's say, for example, if the US housing starts falls sharply, it could weaken USD because it shows economic slowdown in a key sector, that's the construction sector. So now you know the economic indicators to pay attention to, and you also know the most important news events to pay attention to when you are looking at an economic calendar. We'll talk about economic calendar as we move further, but for now, let's quickly talk about central banks and their monetary policies. Now, you should know that a country's central bank is like the main financial authority in the country. It is like the guardian of the country's economy. The job of a country's central bank is to keep prices stable, that's to control inflation, to encourage growth and job creation, and to protect the value of the national currency. And you should know that every country has its own central bank. For the US, it is the Federal Reserve. For Europe, it is the European Central Bank. For the UK, it is the Bank of England. For South Africa, it is the South African Reserve Bank. For Nigeria, it is the Nigerian Central Bank. And for Japan, it is the Bank of Japan. These banks do not just print money, they set the tone for the economy. So now you know the key indicators to look out for. And when you're looking at an economic calendar, you know the news to look out for. We'll talk about economic calendar as we move forward. For now, let's talk a little about geopolitical events and how they affect the value of a country's currency. Remember that we talked about political stability as one of the reasons why investors may want a country's currency. So let's also talk about geopolitical events and how they influence a country's currency value. Geopolitical events are political, social, or global happenings that influence how investors feel about safety and stability. Geopolitical events include the following: elections and political transitions, war or conflict, trade wars and sanctions, natural disaster, global pandemics or health crises, and corruption scandals and government instability. These events affect investors' confidence, and when investors' confidence change, currency value changes as well. Remember, how investors feel play a huge role on the currency's value. So, let's talk about some of these geopolitical events, starting from war and conflicts. When war or conflicts break out, uncertainty increases, and investors, they do not like uncertainty. So when there's uncertainty, they pull their money and invest in safe haven currencies. Currencies that are considered safe haven include the US dollar, which is the world's main reserve currency, the Japanese yen, a traditional safe haven, and the Swiss franc, known for its stability. For example, when the Russian-Ukraine war broke out, we saw a crash in the Russian ruble. At this time, safe haven currencies like the US dollar, the Japanese yen, and the Swiss franc gained value. Another geopolitical event that causes instability is election. Elections cause uncertainty, and as you know, investors do not like uncertainty. So if the outcome of an election is unpredictable, investors usually pull out their investments from that particular country until the election result is called out. And if they believe that the election result is favorable to the economy, like it's good for the economy, then you might see an increase. That's after the election. But if they do not believe or they do not have confidence in the elected leader, we may see a decrease in the value of that currency after the election. However, during that period of uncertainty, during the election, the campaigns, due to the uncertainty, investors may pull out their money and we may see a decrease in the value of the currency. For example, during the US election, there was a lot of uncertainty, Republican or Democratic, who was going to win. A lot of traders just decided to sit that one out and not trade because there's too much uncertainty. Nobody knows what's going to happen to the dollar. Like we explained, just like election can cause uncertainty, leadership change can also cause uncertainty. Now, when we talk about leadership change, it is not necessarily the change of the president, even the change of leaders and members of cabinet. For example, the finance minister decides to resign. It can cause decrease in the value of the country's currency or even an increase depending on the confidence investors had on the outgoing Minister of Finance. Change in government policies can also cause this uncertainty. This sudden type of change in policy that we saw during the trade war between US and China in 2018 can cause the US dollar and the Chinese yuan to decrease in value. Of recent, you must have been hearing about economic sanctions. Today, the US is placing economic sanctions on Russia because of the war in Ukraine. Tomorrow, it's placing economic sanctions on Nigeria because of the set killing of Christians. And next tomorrow, on South Africa because of the issues between black South Africans and white South Africans. There are just so many reasons why there may be trade sanctions on a country. When one country places sanctions, that is bans or restriction, on another country, it can limit exports, reduce trade, and even result to freeze assets. These reduced economic activities can cause the targeted country's currency to also reduce in value, to weaken. For example, when the US dollar placed sanctions on Russia, we saw a decline in Russian ruble. This is because it limited Russia's ability to trade and access foreign reserve. On the other hand, countries not involved in the conflict can gain value because when investors are seeing this trade war between China and the USA, what it tells them is, oh my God, I don't want to be involved in this uncertainty. I'd rather try out other safe havens like the Japanese yen or the Swiss franc or even gold. Another occurrence that can reduce the value of a currency in a way you did not expect is natural disasters. Earthquakes, flood, hurricane, they cause huge damage to infrastructures and businesses. Rebuilding these infrastructures and businesses cost money and can result in weakened currency. For example, in 2011, when Japan faced earthquakes and tsunamis, we saw a temporary increase in the Japanese yuan, and that was because investors brought money into the country to rebuild businesses. However, after this temporary increase, there was also great economic slowdown and weakening in the value of yuan, and that was because of the cost of reconstruction and the fact that some businesses had to pause until they are able to rebuild their buildings and infrastructure before they continue. So natural disasters affect the value of a currency in different ways depending on whether that natural disaster is causing a long-term or a short-term damage. Another thing that can affect economies is global health issues like the COVID-19. In 2020, the world entered panic mode, stocks crashed, and investors started running to safe havens like the US dollar and the Japanese yen. Commodities linked to the US dollar or the New Zealand dollar fell because there was decrease in demand, so there was decrease in exports. What you should note from this is that when fear spreads, investors consider safety before profit, so they run to safe havens. So we would see safe haven currencies and commodities strengthen, like the US dollar, gold, Japanese yen, Swiss franc. Another factor to consider in this context is commodity prices and resource dependence. Some countries' currency depend heavily on commodity exports like gold, oil, copper. When global prices rise, these countries benefit, and when prices fall, these countries also bear the consequence. For example, the Canadian dollar often strengthens when oil prices rise because oil is Canada's main export. And South African rand often reacts to gold and platinum prices. When these prices rise, the ZAR gains value. Now, how do you easily get access to information about war, interest rate, inflation with ease so that you can use them to make trading decisions? Because you cannot just go to search US interest rate, US inflation, Europe interest rates. That's a lot. And that is where an economic calendar comes to play. An economic calendar is like a schedule of upcoming news events that may affect the Forex market. It lists things like interest rate announcements, inflation report, employment data, GDP release, and many other indicators that we've discussed earlier. Each event on the economic calendar shows what time it will happen, which country it is going to affect, and the effect it may have on the country's currency. Think of it like a weather forecast, but this time around for the Forex market. You can easily access an economic calendar by visiting MyTradingLand.com and clicking on the calendar tab. For each economic news, you see data like date and time to show when the news is going to be released. For example, non-farm payroll is released every first Friday of the month by 8:30 a.m. Eastern Standard Time. So see the currency. This tells you which currency is going to be affected. USD means if it is going to affect USD, it means it's going to impact pairs like Euro USD, GBP USD, or any pair that contains USD. If it is ZAR, any pair that contains ZAR. The event's name tells you what the data that is about to be released is about. For example, if it is CPI, Consumer Price Index, it tells you how prices are changing. GDP tells you how the economy is growing. You would also see the impact level represented using histogram bars. 4 histogram bars means high impact level. And you see 4 histogram bars for news events like NFP. 1 histogram bar means it may not be a high impact news and is often ignored by most traders. You would also see actual, forecast, and previous. Previous means the results from the last time that data was released. Forecast means what is expected. And actual means the data that was actually released. So for example, if the US CPI that measures inflation was expected at 3.2%, but the actual result was 3.8%, that is higher than expected. That means inflation price is rising fast. So traders expect the US Fed to raise interest rates to fight inflation, so the US dollar strengthens. But if the actual is lower than the forecast, it's a signal of slower inflation, so the US dollar weakens. The economic calendar helps you to plan your trade. If you are expecting a big news event like NFP, you should know that spread widens, slippage is more possible to happen. When you know that spread is going to widen, there's going to be more volatility, which means that there's going to be slippage. You want to plan your trades properly. If you intend to trade during the period of this news release, you want to plan your trade. You want to pay attention to the news that is going to be released and plan in accordance to it. For more in-depth understanding on how to use an economic calendar, you may want to see the video on how to read an economic calendar. We have a full video explaining that, and I hope you find it helpful. Now moving forward, let's talk about currencies and their correlations. Have you noticed that sometimes two currencies move like together in correlation as though they are twins? And other times, some currencies move in opposite direction. When the value of one currency is increasing, the other currency is decreasing. It is not exactly random. It is called correlation, and understanding how currencies correlate with one another can help you to make trading decisions as well. So in simple terms, currency correlation is just how one currency moves in relation to another, and correlation can be positive or negative. Positive correlation means both currencies are like best friends and they move together, and negative correlation means they move in opposite directions. Some currency pairs have strong correlation, often because they share a strong connection, like a common currency. For example, Euro USD and GBP USD. These two currencies often move in the same direction. This is because both currencies have the US dollar as quote currency. When the USD weakens, Euro and GBP rise together. On the other hand, for most currencies that have negative correlation, it is because they share a currency that is on the opposite side of each pair. For example, Euro USD and USD CHF. USD is the base currency in one of the pairs and it is the quote currency in the other pair. If the US dollar strengthens, Euro USD is going to see a fall in price, whereas USD CHF is going to see a rise in price. It is not only currencies that have this type of relationship. Sometimes we also see currencies and commodities share similar relationship. Some currencies are tied closely to commodity prices like gold and natural resources like crude oil. These are called commodity currencies, and let's look at some key commodity currencies. The Canadian dollar and oil. Canada is a major exporter of oil. When oil prices rise, Canada earns more. Investors buy more Canadian dollar. When oil prices fall, Canadian dollar also falls. Let's say, for example, if oil jumps from $70 to $85 per barrel, the US CAD pair often drops because Canada is gaining. CAD is increasing in value. Another commodity currency to look at is the Australian dollar and gold. Australia is one of the biggest gold exporters in the world. When gold prices rise, the value of Australian dollar rises too because investors are buying the Australian dollar to buy gold. This same thing also happens to South Africa. Because South Africa is also a major exporter of gold, when gold prices rise, South African rand tend to increase in value as well. However, you should note that correlations are not fixed forever. They can change if a country's economy shifts focus. Commodity prices change, central banks adjust policies, and global conditions change. For example, during the 2020 COVID-19 pandemic, almost all currencies weakened against the dollar. Even currencies that do not move in any form of correlation, they all weakened against the dollar. This was simply because of fear and investors running to safe haven currencies. Here's how to use this knowledge of correlation during trading. First, avoid overexposure. Since you know that Euro USD and GBP USD move in positive correlation because of the USD, you want to avoid opening a trade of both Euro USD and GBP USD at the same time, because when you do this, you are doubling your dollar exposure. If the US dollar strengthens, both trades will go against you. Correlation also helps you to confirm your bias. If the price of gold and the price of AUD-USD are both rising, it confirms that AUD is gaining strength. Correlation also helps you spot divergence. Sometimes one pair may move and the other may lag. For example, you may notice that the value of oil is increasing, but the value of the Canadian dollar is not increasing, it is lagging. This may be a signal to you that the value of Canadian dollar will soon follow, and this can help you spot quick entry in the market because you know that Canadian dollar and oil have a positive correlation. Now to move on, you should also know that market sentiment also impacts the value of a currency. Sometimes you hear good news for a country, like it seems like a good news, but the value of the currency is not reflecting that good news. This is simply because of market sentiment. Market sentiment shows the confidence of traders and investors in the currency, in the economy of that country, not just about that good news. Market sentiment is the collective emotion, the fear, the optimism that drive buying and selling decisions, and that's why you need to pay attention to it. In forex trading, traders act on expectations and not just results. Before an important news release like interest rate decisions or NFP, traders already have an expectations that you can see on the forecast. When the data is finally released, traders react not just based on the numbers that were released, but based on the comparison between the numbers and what they expected. If the actual is greater than the forecast, that's better than expected, the currency strengthens. If the actual is less than the forecast, that's worse than expected, the currency weakens. But if the actual is equal to the expected, there's little or no reaction. So for example, if traders expected the US to add 200,000 jobs, but NFP report shows 250 jobs added, that is positive and USD may rise. But if only 150 jobs were added, that's negative, that's less than expected. So USD may weaken in value. Now the question you may be asking is, how do I know market sentiment? You can see market sentiment on TradingView or even in your trading platform, in your broker's trading platform. You can see the market sentiment to know if people are bullish or bearish. You can also understand expected market sentiment by following the news. If the actual is greater than the forecast, you know that there's going to be positive sentiment. So if you follow and understand the news, you can also predict market sentiment. However, per time, your broker, TradingView, they are telling you what the current market sentiment is per time. And of course, you should always combine fundamental and technical analysis. So yes, you know that the actual was greater than the forecast. So when do you enter the market? How do you place the trade? Where do you set your stop loss? That is where technical analysis comes to play. Technical analysis helps you identify entry and exit points. It also helps you confirm signal that you may be getting from your fundamental analysis. So yes, every morning when you wake up to trade, you look at your economic calendar, go to the news tab, see the news that have been released, understand how the economies of the currency you are intending to trade, how they are faring on the news, and then use technical analysis to determine how you want to enter and exit the market. But fundamental analysis is also important, so you don't go to trade during political uprising. I really hope that you found this video helpful, and if you did, don't forget to give it a thumbs up and of course subscribe, and let's know what you think about the video in the comment section. Thank you.